I know a guy that was getting a pension and a financial advisor told him, hey, you can go ahead and retire. Well, he went ahead and retired, and he had to have worked 25 years to get the full pension, but instead he worked 24 years. Well, you would think, okay, no big deal. He's only 1 year off. He'll get a little bit less. But if he didn't work the full 25 years, then he had to take a 5% penalty for every year before full retirement age. Well, full retirement age was like 62 years old. The guy was only 50. So he was going to take like a 60% penalty if he didn't work that 25 years. Now, the advisor didn't really know the questions to ask, obviously, on this, but the client didn't either. And so in this scenario, it cost him a significant amount, and the guy had to go back to work for a while when he thought that he was going to be retired. So it's very difficult with pensions, and so you really got to figure out and just understand the basics of your pension, and then also just know the questions to ask to make sure that that scenario doesn't happen to you. So I want to make sure we go through that. I talk through that with you, and we really just go through each step of the way so that you can figure out. And if maybe there's something that you say, hey, you know what, he didn't mention this, put it in the comments below, because I want to make sure that you are asking the right questions, you're knowing the right things with the pensions so that you don't make any big mistakes. And so when it comes to the basics of a pension, usually there's the first one that you start with is just a single life payout. So if you have a pension that you're getting, you could opt for the single life payout. It's always the highest amount that you're going to be receiving. It's going to be going just to you though. And the risk there is if something were to happen to you and you have somebody that is needing income, then they're not going to get anything. And so there's one, the joint survivor life. This is one that comes into play oftentimes for if you're married and you have a spouse that's also dependent on the income that you're going to be getting from the pension. A lot of times people take the 100% payout, which what ends up happening is let's just say your pension is $4,000 a month that's coming in. Well, if you take the 100% payout, maybe it's only $3,250 a month. And if something happens to you, your spouse gets that the rest of their life as well. Now, there's other breakdowns that you can go through. Let's just say it's the $4,000 a month. You may go with a joint benefit option where it's a $4,000 a month, but then 50% of that to your spouse if something happens to you. So maybe they only get $2,000 a month or 75%. There's different breakdowns there with the way those work. Then you have period certain. With period certain, it's, hey, you know what? I'm retiring today. I'm going to get my pension the rest of my life. But if something happens to me in the first, say, 10 years, well, then whoever the beneficiary is on that will get it for those 10 years. But only those 10 years. That's it. And so it's a tricky one, and it doesn't have to be just 10 years. There's other plans that have a lot of differences, but these are just kind of the basics that you're going to be seeing. Now, then there's some things like a PLOP. A PLOP is a partial lump sum, and that's where you could take a reduced payout on your pension, and then you also get some cash that's tax deferred that you could roll into an IRA to have some liquidity there with what you're doing, or you could just cash out altogether, just get a lump sum where you're just going to say, hey, you know what, I'm not taking the pension at all, and then go that route. Or you've got sometimes what's called a drop. Drop is deferred retirement, where you're actually going to retire on the books, but you're still working. So you start getting your pension. They're going to put this in a separate account for you. And as you're still working, that's going to continue to build. And then eventually when you retire, you'll get your pension. And then you'll also get the deferred money that they've parked away for you. So those are all kinds of different just basics when it comes to the pension. But really then now we've got to figure out what are the questions that you need to ask. And if you don't ask the right questions, it's going to be a big problem for you. So make sure you're asking these. And like I say, please, if you think of something else, list it below, because I really just want to make sure that you're asking the right questions. And the first one is probably the most important. And that is there a cost of living increase? So what I mean by that is when you retire, it could be called a COLA, oftentimes, a cost of living adjustment, or a basically cost of living increase, COLI. And so the way this is going to work though, is if you have, let's just say that $4,000 a month pension coming in, well, if there's a 3% increase on that, well, that means that year, 4,000 times 3% is what you're going to get. So the cost of living increase, and that's going to continue each year and it's going to compound. Now, some pensions have that. A lot of pensions are going away from that because it's costing the pension system a lot of money. So make sure that you're doing the right thing there and asking about that, because if you retire at age 60 with 4,000 a month, well, at age 80, it's going to be a lot less than $4,000 a month just because of inflation. And another one is, what is the funded ratio? So how much of this pension is actually funded? What are the assets versus liabilities? It's kind of like looking at, your balance sheet of your own and saying, hey, okay, here's my net worth, but then I'm going to subtract out all of my debts. Well, in this scenario, we're going to look at the same specifics here and make sure that if you have a specific, amount of money that the pension system has, that's their assets. What are their debts? They decrease that. What's the probability or the funded ratio that they're going to be able to pay out? If you're looking at something over 80%, a lot of people are going to say that that's good. But if it's far under that, let's just say it's 40%, that's saying that your pension system itself isn't really healthy. Maybe you consider the lump sum option. Not always the case, but it's something to consider because possibly your pension may not be able to actually pay you out. Another one is there a specific age or certain number of working years required to meet full retirement? And so it kind of goes back to the scenario I was talking about earlier, where the gentleman had 24 years in. If he met 25, he would have gotten his full pension. But leaving at 24, he didn't meet the full retirement working years. And instead, he would have had to then say, okay, well, now they're basing his pension on the full retirement working age. It's really confusing with this one, but you want to make sure that you're knowing what is needed there. And then you've got, if you retire early, what is the penalty? Just as I'd mentioned with this gentleman, it was, full retirement age was, let's say 62, I believe it was. He retires way before that, and then he has a 5% penalty, or it was 60. Can't remember what I said there, and I can't remember the specifics, but you get what I'm talking about here. And so if you've got a 5% penalty on this, then that's a huge amount if you're retiring early that's going to reduce your pension significantly. If you delay retirement, can you avoid the penalty is a question you want to ask. And then also, will it increase your actual pension payout? Sometimes you say, hey, you know what? I'm going to retire at 60, but I'm going to delay the pension until 65. There might be a little bit of an advantage there for you and a little bit higher of a payout that may or may not make sense in your situation. And then if you are working oftentimes federal jobs, some of these government jobs, you're not paying into Social Security. You want to make sure that you know your numbers for Social Security and find out, was I paying into Social Security? Have I been paying into Social Security? If so, do I get the full Social Security amount, or do I get the reduced amount, which is the windfall provision there? So you've got to watch out with that, because that's something that comes into play oftentimes with the government employee, where you may not get the full Social Security, and if not, that's a big loss on your side if you haven't been paying in, and especially if you're planning for it and already accounting for it. And then really the final one is also on the Social Security side is there some sort of supplement until I reach Social Security age? A lot of pensions have some sort of supplement there that's going to help you just pay out a little extra. And then once you get to full retirement or at Social Security age, even at 62, then they're actually going to decrease that amount that they're paying you in your pension. So all things that you want to consider. Like I say, please, let me know if there's something that I'm missing here. List it in the comments so that we can help others, so that they make sure if they're retiring with a pension, they're doing the right things.